What's up, guys, and welcome to Rare Liquid. My name is Ben. I'm a former JP Morgan investment banking analyst, and today we're going to be ranking the largest private equity firms in the world. And this may ruffle some feathers because private equity firms are notoriously secretive and have a lot of unique attributes. So sometimes things like their investment mandates and strategies are going to make it feel like we're kind of comparing oranges to apples or apples to oranges. My goal with this ranking isn't actually to say that one firm is better than the other, but actually to provide you a lot of really good information throughout this entire video about what makes each firm unique and where they currently stand in 2025. And so the way I'm going to be doing this is by adding structure into the overall rankings and making it as unbiased as possible. I'm going to be rating out of 5 points for the following. First is recent fundraising momentum, which indicates that investors in these firms, aka LPs, have confidence in their track record. Second, overall and recent fund performance, which really shows how well the firm is actually doing its job of investing. And then third, the firm's overall reputation, which is largely debatable, but includes factors like legacy, brand name, culture, and compensation for a total potential score of 15. Now, before getting started, if you're watching this video because you're interested in breaking into private equity, you may want to check out the PE Investing Certificate Program being offered by Wall Street Prep and Wharton, which is where I got my MBA. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code RARELIQUID to get up to $500 off, and I'll leave information for everything discussed in this video's description. All right, so let's now get started with the rankings. You're going to see at the bottom here the top 15 firms that we're going to be looking at, and they're organized in alphabetical order, and I'm just going to be going one by one in that order, just so you guys aren't really sure which one is going into what tier. And so, as I mentioned earlier, I'm going to be giving points for each of the 3 categories we have in our criteria. So starting off with Advent, I'm going to put them in the B tier, and let me kind of go into why. First of all, for just giving you an overview of the firm, Advent is a well-respected pure play mega fund PE shop. They have no other strategies and they invest across all verticals and are based in Boston. For fundraising, they raised a record $25 billion in 2022. And this is especially impressive given the time period because during that time, fundraising appetite wasn't as hot. For performance, I give it a 3. And this is because the most recent vintage posted negative 17% IRR, but this can't be trusted or relied on too much because when a fund is new, the IRR, it takes a long time, at least 5 to 7 years to know how returns actually play out. And the previous 3 funds at the firm had mid-high teen IRR, which is pretty solid. Lastly, for reputation, I give it a 3. It's still a top firm and a great offer, but it has kind of a notoriously brutal and sweaty culture. Varies by team, of course, and most people just don't know about Advent, especially if you're not in the finance world. So compared to like Apollo and KKR, those firms where a lot of people really know, I would say that Advent is one of those firms that's not really as well known. Another thing to note is that comp is pretty average. Base is $150K right out of banking in your first year as an associate. And so in total, Advent earns a total score of 11. Next up on the list, we have Apax, which I'm going to put in the D tier. And to give you an overview of this firm, it's based primarily in Europe, but is not as strong as the other European private equity firms we're going to discuss today. They focus a lot on tech, services, healthcare, internet, and consumer, and are based in London. I gave them a 3 for fundraising because they recently closed flagship 11 at $12 billion, which was very similar to their previous fund, but they missed their target fundraising of $13 billion. And whenever you miss your target, you got to account for that somehow. So that just means that their investors are not as confident. Otherwise, they would have met their target or exceeded. I give their performance a 3 as well because according to PitchBook, performance doesn't seem too bad, but kind of lower towards the end of low double-digit IRR. And then for reputation, I gotta say, since I am from the US and this whole video is really from a US perspective, Apax, coming from a European firm, I would say a European background, is not as strong in terms of reputation overall, not as well known. Opinions about the culture are very mixed, seems to be very heavily group dependent. That's no surprise. And it also seems that the New York team might be on the worser end. Also, reportedly, a little bit lower associate base salaries to in the mid, let's call it 110 to 130K for base. And then so in total, I give Apax a score of 9, which lands it in the D tier. Next up on the list, we have a firm that all finance bros know, Apollo. We're going to put this one in the S tier, but there's going to be some context that you may be surprised to hear. So in general, Apollo is known for doing deeper value, complex, and hairy transactions. In terms of fundraising, I gave them a 5 because they have solid fundraising momentum. And while not as large as Blackstone and KKR and ranking 29th overall in the past 5 years of fundraising, the firm recently announced that it's targeting its largest ever fund at $25 billion in early 2025. So let's see how that goes. I gave performance a 3. Fund 9 had pretty solid IRR of 21%, but in general, Apollo has gotten so large that in comparison to some of the other players we're going to see here that have much higher IRRs, it's not as great as those other firms we're going to talk about. And then in terms of brand name, I gave it a 5, or general for reputation. You know, everyone knows Apollo. If you're especially in the finance world, it has stellar exits to hedge funds and pretty much everywhere else you want to go. On the flip side, of course, you do have a notorious culture where you're working extremely brutal hours. And the other thing that Apollo is really well known for is just top of the street comp. Right out of exiting out of your 2-year banking stint, you can expect total comp of 400K or around there, which is more than pretty much every other private equity firm on the street. And then so in total, we have a score of 13 for Apollo. Next up, we have a name that a lot of you guys are probably familiar with, Bain Capital, but you may be kind of surprised that I'm going to put it in the C tier, but you'll kind of hear why. Overall, it's a well-respected PE shop with a lot of strategies, including real estate, infra, and credit. One of kind of the OG PE shops and used to command a super high kind of reputation, and it still kind of does, but not as much as before. And it really invests across all verticals and is based in Boston. So for fundraising, I gave it a 3 because it's currently raising its flagship 14 fund at $10 billion as its target. Previously, the fund size for funds 13 was 11.8 billion. So you see that fundraising target kind of coming down, which is not a super great sign. Next, in terms of performance, I gave it a 3. Fund 13 had an IRR of 9%, which is not great at all. Fund 12 had IRR north of 20%, which is pretty solid. And so because things are kind of both good and bad, that's why I kind of gave it a 3. And then for reputation, I gave it a 4. Bain Capital is a really well-recognized name. And it's also one of the large PE firms that is kind of known for having a generally good culture. They won't work you super hard like Apollo kind of has like a nice guy type of vibe. But of course, it really depends on your group. And if you're on multiple live deals in a row or something like that, of course, any PE shop, your life can be honestly kind of like a living hell. Bain Capital is also kind of known these days to be shifting away from its typical buyout strategy for PE firms. And so it may be interested if you're interested in beyond just buyouts, then Bain Cap could be a good option for you. And a lot of also really good exits to hedge funds, business school, and etc. So overall, a great firm. Next up, we have Blackstone, which we're going to put in the S tier, which may not come as a surprise to a lot of you because Blackstone is probably one of the most recognized brand names that are out there in finance. For fundraising, I gave Blackstone a 5, and you may even argue that fundraising is Blackstone's core competency. It's kind of known as a sleep easy fund for LPs who won't get fired for investing in Blackstone because it's such a well-known brand. And then for returns, I gave it a 3 because it kind of has been producing mid returns over the past decade or so. A lot of people and my friends in private equity have actually mentioned this to me personally. And then for brand and overall reputation, I gave it a 5. It's just pretty much the undisputed most known, well-known name in private equity, has stellar exits to pretty much every single exit opportunity you can think of. And the last note I want to make is that comp is relatively low, total comp around low 300K, which is a lot less compared to the top of the street Apollo, which is also in the S tier as well. The next one on the list may be one of the most surprising rankings for you if you're not too familiar with the PE world, and that is Carlyle, which I'm going to put in the D tier. Let me kind of go into why. Overall, Carlyle is one of the first early pioneers of the LBO and the private equity industry and has a very recognizable brand name. Has a lot of diversified strategies like other mega fund PE shops, but overall, the firm has taken a pretty dramatic fall lately. For fundraising, I give it a 2 because it raised flagship fund 13 at $14.8 billion, missing its target by over 50%, which is huge. Many previous LPs pulled out from committing more capital to the new fund, which just honestly says a lot. And then for performance, I gave it a 3. PitchBook numbers show that flagship fund performance at mid-single digits, which is pretty low. And then for reputation, I gave it a 4. So Carlyle does have, as I mentioned, a really, really strong brand, but it's taken a really hard fall over the past couple years. But I would still say that the brand is still, in general, pretty strong. And if the firm is able to kind of rebound over the next few years, then who knows? Carlyle could be, up in the rankings. But over the past few years, there was a highly publicized botched succession. And then the firm also cut out its entire consumer and retail team in 2023. So given all of that's happening with Carlyle right now in 2025, I'd say it's really in this D tier with a total score of 9. Next up on the list, we have CD&R, which we're putting in the A tier. And overall, the firm is a pure play buyout shop founded in 1978. So a pretty dated history like other legacy private equity firms. They invest in TMT, healthcare, consumer, and industrials, and is well regarded for having really, really sharp investors and kind of an old school vibe. I actually worked with CD&R as a potential buyer in one of my transactions when I was at JP Morgan, and they were super, super sharp. First of all, for fundraising, I give them a 5 because they smashed fundraising with a $26 billion fund, nearly $10 billion more than their previous fund, and also went well beyond their $20 billion fundraising target. And so this means that CD&R has a larger fund than a lot of other legacy mega funds like Bain or Carlyle and TPG. In terms of performance, I give them a 4. 2018 Fund 10 had a really, really strong IRR of 33%. And then their more recent fund at 2021, Fund 11, is currently at around 4.4%. So I will say that, again, you can't really trust IRR for a recent fund because it takes 5 to 7 years for investments to play out. But I will say, this is kind of one reason to kind of peg down CD&R just a little bit. That's why I gave it a 4 for performance. And then for overall reputation, I gave it a 3 because it's not as well known. It's kind of like Advent, where if you're not in the finance world, no one really is going to know about this firm. Also, in general, in comments about its culture, as I mentioned, old school, kind of a stuffy vibe, tough to ascend beyond associate, but great for business school placements. And the culture really varies a lot, but overall is kind of known for being a little bit of a sweatshop in a sense. Compensation is also above street, typically with about a base of 175K plus. And so in total compensation, somewhere around the high 300s, 400K for your first year out of banking. Next up on the list, we have CVC, which we're going to put in the A tier. And this is one of the largest European mega funds in private equity. The firm recently went public as well. And they also invest across multiple industries like consumer, financial, healthcare, industrials, IT, communications, etc., and are headquartered in Luxembourg. I gave them a 5 for fundraising because they closed their latest fund at a $26.5 billion euro target, which is the largest that they've ever raised in 2023. For performance, I gave them a 4 because their flagship fund performance aggregate across funds 1 through 7 have delivered average gross IRR of 28%, which is pretty solid. And then for reputation, I give them a 3. Again, kind of coming from a US perspective, it's a very well-respected firm, good performance, and etc. I would just say that compared to other offers you would get in the US, CVC is not as strong, but if you're based in Europe, then CVC could definitely be in the S tier for you. But coming from my perspective, if you had an offer at CVC or let's say Blackstone or even CD&R, then I would probably take those offers. So anyway, the firm has a total score of 12 and sits well in the A tier. Next up on the list, we have EQT, which is another European-based fund, and we're going to put it in the B tier. Overall, I give this a 5. For fundraising, I give EQT a 5 because they raised a $24 billion buyout fund in 2024, exceeding fundraising targets by $2 billion. And the firm is 40% larger than the one before. So this indicates just a lot of LP interest. For performance, I give it a 3 because there's kind of a mixed bag with recent funds. For their Fund 9 in 2020 and Fund 10 in 2022. These produced negative to mid-single digit IRRs, but their older funds produced IRRs in the low 20s, which is really solid. So because it's kind of a mixed bag, I gave it a 3. And then for overall reputation, again, because it's Europe-based, I gave it a 3. It's a very well-respected firm, pretty solid performance and good fundraising. So you can't really knock the firm too much. Again, if you're in US, then I would say EQT and CVC are probably comparable offers, but I would say just a tad lower for EQT because of its performance. Next up in the S tier, we have Hellman and Friedman, and this may come as a surprise if you're not too familiar with the private equity world, but if you are in the finance world, then this is really one of the top offers you can get. I kind of liken it similarly to PJT restructuring in New York, where if you're not well versed or don't really know about banking, that sounds like an offer you would never take over like Goldman Sachs. But Hellman and Friedman, oftentimes you may take this offer over Apollo, Blackstone, and etc. So in general, the firm is known for having very, very intelligent investors and seniors, very value oriented and likes really hairy deals, does some big tech deals. With that said, going into fundraising, I gave them a 4 because they slightly missed their fundraising target, but it's still a massive fund. So they recently raised $22 billion versus a target of $24 billion. And so I kind of knocked them down just a little bit for that. But in terms of returns, I gave them a 5. They have gross IRR of 30% since inception in 1987, which is super solid. And then for overall reputation, I gave them a 4 because they're not as well known as Apollo, Blackstone, KKR. But in the private equity world, they're extremely well respected. And so I gave them an overall score of 13. Last note I want to add is that they're known for having comp in the low 300Ks in total comp for 1 year out of investment banking. Next up, we have KKR, which we're going to put in the S tier, which may not come as a surprise to a lot of you because KKR is one of the most well-known funds. I'm not going to go into too much about KKR because you can actually think of pretty much the exact same stuff that you think about Blackstone or what I said as KKR. In terms of fundraising, I give it a 5, super good at fundraising. Performance, I gave it a 3 because it's pretty mid because the firm has just grown so much. But overall reputation, I give it a 5, one of the best brand names out there in private equity for an overall score of 13. Next up on the list is Silver Lake, which I'm going to put in the S tier, which may be slightly controversial. Some people may want to put it in the A tier, and I'll kind of go into why. But overall, the firm, just like Vista and Thoma Bravo, these 3 companies and PE firms are lumped together a lot because they all focus on tech. And compared to the other 2, Silver Lake is known for having a bit of a broader mandate and investing across all of TMT, whereas Vista and Thoma Bravo are a little bit more niche. But in general, the firm is very, very well regarded. In terms of fundraising, it recently closed a $20.5 billion fund for Fund 7, only slightly larger in size than their previous Fund 6. So I gave them a 5 because it's raising $20+ billion, a lot of money. Next, for performance, I gave it a 4. Gross IRR of 21% for the past 15 years. Slightly underperforms other software tech PE investors or PE firms like Vista and Thoma Bravo, but still pretty solid. And then for overall reputation, I gave it a 4 because while it is super, super well respected in the private equity world, outside of it, a lot of people don't know about Silver Lake, so that's why I gave them a 4 for a total score of 13. All right, next on the list, we have Thoma Bravo, which I'm going to put in the S tier. And overall, Thoma Bravo is the most prominent tech and software focused mega fund PE shop and is extremely, extremely well known in the private equity world. They have a few other strategies like credit. First off, for fundraising, I gave them a 5 because of their strong fundraising momentum in 2024. They raised $24 billion for their flagship fund in a couple of months. Now for performance, I gave them a 4, and this may be a little bit controversial because typically you may consider giving them a 5, but more recently in 2021, they deployed $50 billion in really, really high multiples. And so the firm is kind of thought to be in a lot of trouble, at least with that fund, but they clearly had no issues fundraising lately. And for their vintage funds in the mid 2000s and onwards, they had IRRs of 20 to 45% plus. So just extremely solid performance and really, really strong track record overall. That's why I kind of gave him the benefit of the doubt still and gave him a 4. And then next, for overall reputation, I gave them a 4 because, again, they're not as well known as your Apollo, Blackstone, KKRs of the world, but within the finance world, super, super well respected. And so that's why I gave the Thoma Bravo an overall score of 13, and that's why it fits in the S tier. Next on the list, we have TPG, which we're going to put in the C tier. Again, may come as a bit of a surprise to some of you because TPG is really, really well known. Overall, similar to KKR, Blackstone, and Apollo, was one of the first US PE firms to complete an LBO, but smaller in size compared to those 3 that I mentioned in terms of assets under management. The firm also has a very diversified strategy and platform with real estate, credit, and growth, and is based in Dallas, Texas, and SF, which could be a differentiator, good or bad for you, depending on what you're looking for. For fundraising, I gave them a 3 because in 2024, they raised their flagship fund 9 at $12 billion and healthcare at $3.6 billion. Both succeeded their previous vintages in size, but dialed back fundraising targets. And that's not really the end of the world, but because they kind of did dial it back, I will say that I kind of knocked them just a little bit for that. Next, for performance, I gave them a 3. 2 most recent vintages posted 16%-ish and low high teen IRRs. So just kind of middle of the line performance, not super great and not super bad. And then for overall reputation, I gave them a 4 because the firm is super, super well known, one of the legacy brand name PE shops, kind of has an old school type mentality or culture that is particularly strong in healthcare, but has been struggling a lot lately in terms of performance and a lot of departures of senior investors. So that's why I gave it a 4 overall and an overall score of 10. Last but not least on the list, we have Vista, which I'm going to put in the A tier. And a lot of people may look at this and think Silver Lake, Thoma Bravo, Vista, they're all pretty similar. They should all be in the same tier. But let me kind of go into why I didn't, at least as of 2025. So in general, Vista is one of the strongest pure play software PE investors and is based in Austin, Texas. For fundraising, I gave it a 4 because while it did raise $20 billion, which is a lot, and it went beyond its $17 billion target, it took 3 years. And so whenever you're fundraising, if you can fundraise super quickly and you go beyond your target or you reach your target in a short period of time, that really shows a lot of investor confidence. It takes multiple years, then there's something else kind of happening. And so that's why I took it down a notch a little bit. For performance, I gave Vista a 4, which may come as a surprise because their gross IRR since 2000 has been 37%, which is insane. But more recently, the fund has been kind of faltering. They fell into the 2021 trap where they invested and deployed a ton of money at really, really high valuations. And they're also publicly kind of went through a lot of bad press for having some zeros in their investments, particularly with an investment called Pluralsight. And so that's why for performance, I can't give it a 5 out of 5, give it a 4. And then next, for overall reputation, I give it a 4 because while it's super, super well respected within the private equity world, and especially if you want to invest in tech, then you would want to go to Vista. Compared to Blackstone, Apollo, KKR, not as really strong overall in terms of brand name. So that's why I gave it a 4, score of overall 12, and that's why it's in the A tier. All right, so those were the rankings for 15 of the largest private equity firms in the world. Let me know in the comments if there's anything I missed because there's so much information out there and at the same time, not that much about private equity firms because they're so secretive. So let me know if there's anything that I should think about differently in the comments. That said, thank you all so much as always for watching. In the next screen, you're going to see a video about a brutal week in the life of a private equity investor. With that said, thank you all so much for watching and hope to catch you all in the next one.